again, everybody, and welcome to the 6th episode of Rethink's mini podcast series designed to focus on and explain the aspects of the UAE's corporate tax legislation most relevant to your business and your investments, and to demystify some of the more complex aspects so you are well prepared in advance of the beginning of your next financial year, the first that will be subject to corporate tax, or CT as it's known. My name is Neil Guthrie, and I'm once again joined by Kirti Vudamudi, our Director of Tax.
Hello, everyone. Welcome to you all.
Now, in previous podcasts, we've explained the basics of CT, how it will impact your business, some aspects that will be particularly affecting medium-sized and larger businesses, what free zone entities need to be aware of, and in the last podcast, we focused on holding companies and SPVs. In this podcast, by popular demand, we're shining a light on the CT implications for foundations, which are a key element of the UAE's wealth management ecosystem. So, foundations have been available in the UAE since 2017, and they've rapidly become the go-to option for regional wealth structuring and intergenerational legacy planning. In fact, there are now more than 600 foundations established in the UAE in DIFC, ADGM, and RAC ICC free zones. And that number is projected to increase by 25%, 1/4 in 2023. And they are an effective means of high net worth individuals securing their assets and protecting their legacy. But foundations are free zone entities bound by the same legislation as commercial free zone entities, although there are aspects of the corporate tax legislation which are specific to foundations. And of course, we'll be spending some time telling you about those specific aspects as we go through this podcast. But we do recommend that you view this podcast in conjunction with episode 4 of our podcast library, where we talked in general terms about the CT implications for free zone entities. And there's a QR code to get you straight through to that podcast. In terms of the areas that we'll focus on, well, clearly we're going to focus on the CT aspects of foundations, but we will touch upon in a little detail about what a foundation is and its benefits for the benefit of those that aren't familiar with foundations. What we won't cover is in any great detail the legal, regulatory, organizational, and governance aspects, nor will we go into the relative pros and cons of the free zone options for setting up a foundation. We leave that to the specialists. Here we've given you a link to a QR link to a library of information on foundations produced by our sister company, MHQ, which is the leading company in setting up foundations in the UAE. So what is a foundation? Well, a foundation is similar to a company. It does have an independent legal entity, which is distinct from the personality of the founder. But unlike companies, it has no shareholders or members and does not issue shares or any other legal title to ownership. In fact, it's what's called an orphan structure. The scope of the permitted objects of a foundation is wide. It can be succession planning and philanthropy, but it must not be for commercial purposes. And typically it holds wealth and assets on behalf of beneficiaries. A foundation is governed by its charter and its bylaws, its charter being publicly available, the bylaws being strictly private. It's managed by a foundation council and often supervised by a guardian. And it may enter into contracts such as a tenancy agreement or hold assets such as real estate or shares in its own name. And UAE foundations are available to UAE residents and non-residents alike. And foreign registered foundations can migrate to either DIFC or ADGM. In terms of the benefits of a foundation, well, as a succession, wealth management and legacy planning vehicle, foundations offer a solid governance structure with confidentiality, whilst permitting the founder to retain significant control powers via the bylaws if they so desire. It was introduced domestically with Muslim successions in mind, and used adequately, it can provide robust asset protection and safeguarding of assets from forced heirship, divorce, or creditor claims. And of course, it benefits from a benign tax regime, which we'll talk about a lot more in this podcast. And in terms of the assets that a foundation can hold, well, it can hold UAE assets such as investment portfolios, bank accounts, shares in family businesses, UAE land, UAE real estate, collections, and artwork, and so on. So that's the background. Let's now concentrate on the UAE corporate tax aspects and how it relates to foundations. So Kirti, does the legislation mention foundations specifically?
Yes, indeed it does. The legislation refers to a family foundation and states that to be considered as a family foundation, it must meet certain terms and conditions. The conditions are: the foundation is established for the benefit of identified or identifiable natural persons, or for the benefit of a public benefit entity, or for both. The principal activity of the foundation is to hold, receive, invest, disburse, otherwise manage assets or funds associated with savings or investment. The foundation does not conduct any activity that would be constituted as a business or a business activity under the corporate tax law. The definition of business or business activity is not yet clarified by the FTA, but based on the VAT law, we can understand that the definition is quite wide and covers all regular and commercial activities. The main purpose of the family foundation is not to avoid corporate taxation and any other conditions as may be prescribed by the ministry.
Thanks, Kirti. So what's the tax status of a family foundation?
Well, as you mentioned earlier, Neil, the family foundations are also free zone legal entities. As such, provided they adhere with applicable regulations and subject to clarifications to be provided under the cabinet decisions, being along the lines as we expect, the rate of corporate tax for foundation should be at 0%. What's more, there are effectively two further layers of insulation for corporate tax for family foundations, which will come into effect and we will discuss later in this podcast.
Intriguing and encouraging in equal measures, I would say. But I'm guessing that the news is not quite so upbeat when it comes to compliance.
Well, that's certainly the case. Being free from corporate tax is one thing, and not having to comply with the aspects of the legislation is another thing altogether. Family foundations are fully in scope for corporate tax for their worldwide income. As such, they must fully comply with the legislation. This includes registering for corporate tax, a one-time requirement, filing tax returns annually, producing annual accounts to the prescribed standard, that is notably IFRS or US GAAP, potentially requiring an annual audit by an independent auditor. In common with free zone legal entities, the foundation should also comply with regulatory requirements to ensure that the CT rate is 0% and it is maintained that way. These regulatory requirements are adherence to free zone regulations, maintenance of economic substance, adhering to transfer pricing regulations, deriving qualifying income, the definition of which is yet to be published. As mentioned previously, additional information on this particular aspects is explained in detail in podcast 4. Viewers can view that for further detail.
Thanks, Kirti. So what about this second layer of insulation that you teased us with earlier in the podcast?
Okay, I won't keep you in suspense any longer. The second layer of insulation against corporate tax for family foundations comes in the form of legislation's provisions for passive income, such as dividends, interest, rental income, capital gains, which by definition will be the family foundation's source of income. We covered corporate tax and passive income in detail in podcast 5. We also recommend you to view podcast 5 in conjunction with this particular podcast. In brief, UAE sourced passive income, with exception of capital gains, is exempt for all entities, and foreign sourced passive income and UAE sourced capital gains are exempt under the participation exemption provisions, subject to certain terms and conditions. At this point, the legislation provides no further guidance on the interest income or the rental income, the real estate rental income, although it is widely assumed that these will be treated as qualifying income and will be 0% for the corporate tax.
Thank you. And I believe there's still more good news for family foundations from the CT tax legislation.
Yes, as I mentioned earlier, the third layer of insulation for corporate tax for family foundations is also provided by the law. So long as the foundation meets the criteria of Article 17, that is the definition of family foundation we discussed earlier in this podcast, it may apply to the Federal Tax Authority to be treated for tax purposes as an unincorporated partnership. Once the family foundation obtains the status of an unincorporated partnership, all related provisions of the law that apply to the unincorporated partnership, particularly Article 16, will also apply to the family foundation. The unincorporated partnership is not considered taxable juridical person in its own right, and the natural person conducting business as an unincorporated partnership are treated as individual taxable persons. This is commonly known as physical transparency or tax transparency. This means that each partner is subject to UAE corporate tax on their share of income from the business conducted through the partnership. Therefore, a successful election in this regard by a family foundation would result in the founder or settler and the beneficiaries remaining to be seen as owners of the assets held by the family foundation and will be assessed for tax purposes as natural persons or individuals. This would generally prevent the income of the foundation from attracting corporate tax. Now, whether it makes sense to apply for such an application to the FTA would depend on multiple factors, such as taking advantage of double taxation avoidance agreements, personal circumstances of those associated with the foundation, the objects of the foundation, assets held by the foundation, and the upcoming cabinet decision on qualifying income, of course.
Thanks, Kirti. Very clear and very concise. So what should UAE family foundations be doing right now to prepare for CT? Well, to start with, they need to be assessing if their accounting administration is adequate and up to the standards required by the legislation. Ensure that you're meeting all the compliance obligations that Kirti outlined earlier in the podcast. Assessing foreign dividends and domestic and foreign capital gains against the participation exemption rules that, again, Kirti outlined earlier. And we recommend you model the tax implications of electing to be treated as an unincorporated partnership versus not making the election and the foundation being taxed in its own right. And of course, checking the appropriateness of the pricing of transactions with related parties and connected persons, the so-called transfer pricing regulations. So there you have it, CT for foundations in a rather complex nutshell. We hope you found this podcast to be useful, at least. And remember the 3 layers of CT insulation, which should mean that, barring no unexpected cabinet decisions, and with careful planning and execution, that family foundations should be able to be tax-free. Next time, we're going to talk about the investment manager exemption. But in the meantime, we wish you a very pleasant day, and we thank you for your time, and we hope to see you next time. Thank you very much.
Thank you very much. See you soon.